The S&P 500 today trying, by the way, for its 7th straight positive session. Today's gains coming after Saudi Arabia extended its oil cuts through the end of the year. Joe, I'm going to go to you first here. So we're on pace for oil to have its 8th straight day of gains. The sector, obviously, has woken up. Is it for real? Is it for real?
So you're going to have to accept more risk if you are looking at the spot price of oil and trying to invest accordingly in energy equity names. And let me give you an example of exactly what I mean by that. So far, quarter to date, the spot price of oil is up 22%. The XLE is up 12%. If you think that you're going to be able to invest in energy through ExxonMobil and Chevron, you're going to be disappointed. You're going to have to accept a higher beta exposure in energy to capture the breakout in the spot price of oil.
Why?
So it's going to be.
Tell me why.
Because
tell me why you say that.
What has happened right now is that the price of oil is moving with such strong momentum. What you need to be positioning towards is companies that, number one, have been underperforming while crude has been in a sideways range, and number two, have a higher sensitivity to the spot price of oil rallying and therefore having an accretive impact on their revenues. ExxonMobil, Chevron, they're more well diversified. So a more significant move in the spot price of oil up or down is not going to have more of the impact that a lot of these high beta names, like a Pioneer, like a Hess, like Apache, like Phillips 66, or Schlumberger, or Halliburton is ultimately going to have. So all I'm saying is, if you're looking at the spot price of oil and think you're going to get the same 20% that spot oil's giving you, just understand you have to accept more risk. You have to go higher beta in your energy exposure. Chevron, ExxonMobil, not getting it done.
Josh?
Totally agree. Joe is right. There are times when you want to be in the integrateds because they have fortress balance sheets and they're paying huge dividends. They could buy back stock when the market is volatile. And that trade actually worked really well last year. I think if you're a bull on energy, it's time to stop jumping out of the basement window with a parachute. If you actually want to make something on this trade, you're going to have to scale down in market cap. You're going to have to scale up in beta or risk of volatility. And I think you want to be more biased toward domestic names. You want to be more biased toward small and mid cap because those are the names that really have the most to go up if you're constructive on oil and you end up being right. So I'm in IEO. And I've been in this for a while, and I underperformed the XLE, as I mentioned, but now that's starting to switch. Over the last 6 months, this thing is leading. And what this basically is a portfolio of all of the non-majors. It's got some big companies in here, but the companies that are actually producing oil. And, Conoco is the biggest weighting. It's 18%. But then you have Pioneer in here. You have Hess. You have Cheniere, Phillips 66. Look at the valuation here. You're paying less than 10 times forward earnings for the portfolio right now based on forecasted earnings for the group of stocks. It's 0.77 times forward sales. And you're basically getting a forward dividend yield, forecasted, of course, of 6.25%. And you're going to get that high beta trade as energy prices go higher and people try to buy the stocks to capitalize. Take a look at a 3-year chart. You could see $102, $105. That range, that was the top in November of 22. Yep. I think we're going to take that level out to the upside, and this will be a bona fide technical breakout, and these are very cheap stocks.
Okay. Jenny?
Well, I'm the basement window parachute jumper, right? So most of our energy is in the midstream space. So Enterprise Products, Energy Transfer, Kinder Morgan, Williams. So I really still like that play, and all this kind of bullish scenario does for me is say, like, yeah, you're going to get your 8 or 9% dividend yields on those stocks. That's what I want them for. But I think there's an interesting point where Josh, you said play domestic, play small, play mid. We're actually, in our international income strategy, we're in Total and Shell. And I think that's an interesting play, too, because you have all the growth there, right? You've got all the security of the Exxons and and Chevrons, but they're trading at almost half the multiple of their U.S. counterparts just because they're domiciled overseas. So like that's actually a great way to play. I would look international, and I would still say stay large integrated. Yeah, I think that's it. You guys covered just about everything.
All right.
Jenny, they're always cheaper than the U.S. majors, and it's not just because they're domiciled overseas. It's because they're domiciled in governments that are hostile to profitability.
Josh, I know that, but the price differential, the valuation differential is too wide for right now. It should narrow. I think that there's, if you want to get into the whole international play, like there's extra add from there. It's a great way to play them, and they have huge, juicy dividends too, so you maybe get your cake and eat it there too.